Hi, this is Yeung of Admiral Investment. Last week, we have discussed how net asset value, or NAV, is calculated. NAV is an important step in generating a valuation for a stock, and it usually is a good rough indicator of a stock's value. However, in practice, share price does not always correlate with NAV. Today, we'll go through 3 of the common reasons. First, while analysts try hard to match the quality of a REIT's assets to the correct cap rates, in reality, asset quality is heterogeneous. Some assets that look good on paper may actually be subpar to expectations, while other assets may do substantially better than the rest of their asset class. For some asset classes, such as mall, management capability is an important factor in what is achieved. Therefore, actual asset price can be materially different from what is calculated by the model. Analysts need to verify the quality of a REIT's major assets by desktop tools such as Google Maps and by actual site visits. Second, cap rates by definition reflects current market price. When the economy goes through major inflection points, cap rates from observed transactions can quickly go stale. Thus, it is often difficult to calculate an accurate NAV even if the analyst is correct about the overall market direction. The experience of the investment team is key in these situations, when the model temporarily breaks down but the profit opportunity is potentially the largest. The third type of model breakdown is when the capital markets itself fails. Before 2010, for example, mergers between Japanese REITs were next to impossible because of tax reasons. As a result, the smallest J-REITs traded at substantial discounts to NAV for a sustained period of time. When the systems were later reformed, these J-REITs rebounded to a level close to NAVs. For this mechanism to work, the actual acquisition is not necessary, since investors will buy if the market believes that acquisition is a material possibility. The 3 scenarios mentioned above are good examples of what may cause stocks to trade away from their NAVs. In normal circumstances, analysts can calculate NAV with some certainty as long as they closely follow the property markets. However, stock price can still deviate from the NAV in a majority of cases. Some REITs and property stocks trade consistently below NAV, others trade on par with NAV, and yet others trade at a premium to NAV. This deviation comes from the value of management. If the REIT management team generates alpha for shareholders, then shareholders will pay a premium to NAV for the management's profitable strategies. If, however, management is losing money, the market typically trades the stock at a discount to NAV. Therefore, the second step of valuation is to calculate fair value, which values a management's strategies in the medium term. We will discuss fair value in more detail next week. In the last 2 weeks, we have discussed net asset value, which is the first step to value a REIT. NAV is generated by first valuing a REIT's real estate portfolio, then adding the REIT's cash, and taking out its liabilities. Real estate value is generated from cap rates tracked by analysts and the net operating income that is calculated from announced financial statements. NAV is a cash value representing the cash to shareholders if the REIT is liquidated. However, the NAV model does not always function, especially during inflection points or when specific market mechanisms break down. In these situations, the ability of the investment team becomes key. In addition, stock price deviates from NAV because of management capability. To value the management, we will need to calculate fair value, which we will discuss next week.